ओम गुरुर् ब्रह्मा गुरुर्विष्णु गुरुर्देवो महेश्वरा गुरुर् साक्षात् परब्रह्म तस्मै श्री गुरवे नमः। विघ्नेशानमुने गुरु सस्मरुने लक्ष्मी स आवाहिले आम्ही गुंतवणूक शास्त्र शिकण्या हे सत्र आरंभिले किंवा स्थावर आणि जंगम कधी कुठे किती गुंतवू चर्चा मंथन तज्ञ बोध मिळता हे प्रश्नही सोडवू ठेवी भाग सुवर्ण पोस्ट अथवा रोखे तसे फंडते वृद्धी भांडवली मिळो कर नको पर्याय हो कोणते कुठे उत्तम रोखता सुगमता लाभांश वा व्याजही कुठे गुंतविणे सुरक्षित असे नोंदीस कैसी वही सन्मार्गे धन संपदा मिळविणे अत्यंत आवश्यक पैसा ध्येय नसे म्हणून जपणे जाणीव सामाजिक ज्ञानाचा उपयोग गुंतवणुकीसाठी सदा होऊ दे हे सारे समजावया सुमती दे आम्हास तू शारदे शुभम भवतु. Good morning friends. I welcome all of you to this third webinar organized by Lokmanya Seva Sangha PV Bhagwat Investment Guidance Cell, and we are all set to hear Mr. Mrugank Paranjpe, who is ready to deliver his talk with presentation. Before we begin the talk properly, I would like to say that after COVID-19, we have started our meetings through webinar, and this is the third meeting, and the next 3 meetings have already been planned. That is on 7th of June and 28th of June. Please wait for the announcement, the name of the speaker and the subject. You will be enriched so far as those meetings are concerned, and you will be also enriched by today's meeting also. So far as today's subject is concerned, many times people wonder whether commodities will take over stock market. What will be the presentation of commodities after COVID-19? What is going to be this global supply chain? What is going to be the situation in India? What is the situation so far as gold and silver is concerned? Several things come to our mind. They are going to have a tremendous impact on economy after COVID. In order to understand all these areas, we have with us Mr. Mrugank Paranjpe. We have already circulated his complete biodata for the benefit of our members. He is not new to us. He has already spoken twice so far as our investment guidance cell is concerned in finance fair, etc. And he is always a helpful person so far as Lokmanya Seva Sangha investment guidance cell is concerned. Besides the biodata which is already with you, I would like to say a couple of things about Mrugank. One, he is always accessible to all of us. Two, he runs an organization called Prabodhan Manch and gives us a feast of lectures on various topics. 3, he is currently Vice President of Lokmanya Seva Sangha. He is on the consultancy board of Lokmanya Seva Sangha. He is expert so far as banking and finance and commodity market is concerned. Former CEO of MCX, one of the most referent commodity market, and he will guide us through the next about 50 to 55 minutes so far as this post-COVID-19 situation is concerned. And thereafter, there could be questions and answers. All questions may please be directed to Mr. Uday Tardakar. He will ask the questions to Mrugank and he will answer. So normally we welcome the speaker with some sort of a memento. Now this e-memento is not possible. So I'm going to give Mr. Mrugank Paranjpe lots of our love and affection, and that over to Mrugank.
Thank you, sir. And a very good morning to all of you. I'm just going to start my presentation and so that you can see it as well. What I'm really going to talk over the next 50-55 minutes, and I'm not going to talk that long, I'll probably leave a lot more time for question answers, is about how commodities is emerging or has already emerged as a true alternative class in terms of investment. And that too, more significantly, how that will change when we see what happens in the post-COVID world. Coming to investments, and I thought we should first understand how investment journeys happen, because that is really how you would then appreciate how an asset class comes into your decision making. So most of us, when we are making an investment, will have a goal, and that goal is typically on one hand either capital preservation. So you want to preserve your capital. Your biggest concern is to keep your capital. This is typically for risk averse investors. This is for people who are slightly later in their age or are a bit conservative. And what they really want from their investment is some steady stream of income if possible, but mainly capital preservation. And then you go to the other side, and as the speedometer there indicates, it is really where you are looking at very high capital appreciation. You are willing to take risks. You are willing to put your capital at risk if required. But what you really want is high capital appreciation. You are also probably okay with not getting some regular cash flows, but what matters to you is capital preservation. So I think most of us have those goals in our mind. But what happens, and I think this is where we at least at my firm believe that we should all think a little bit more, is that typically we quickly jump to saying, okay, if this is what you want, then this is how you should allocate your assets. So it's a very standard thing. Somebody will come and tell you that, if you're looking at capital preservation, put something in debt, put something in equity, put something in gold, be very low on equity. Whereas if you want capital appreciation, go high on equity, etc. So I think without spending adequate time, many a times we don't really analyze this whole goals aspect, and we jump to the asset class allocation. And once you've jumped to asset class allocation, going to the product becomes the next easy thing. So if you want to do gold, gold ETF makes sense, or gold bond makes sense. Or if you want to do equity, stock markets makes sense. So I think instead of sort of taking that, we always advocate, and I would really say all of us should do that, is to spend a little bit time, and we call this reimagining investing. And why do we say it's reimagining investing? Because in many ways, most of us are a little bit, sort of, as I said, in a haste sometimes to jump to the asset classes. So when you're reimagining investing, I would say look at your goals. So if it is safety, then what you're looking at is protection for a rainy day. Your expected returns, not really matters, right? You really want that asset to remain safe. I don't think people have tracked the traditional safe assets like gold or real estate. You don't bother about liquidity. You don't track whether there's going to be much losses. But yes, there is an assumption that this is a very safe asset class, and therefore that is what you would look to. Next, as you slightly start increasing your risk appetite and you're looking for a little bit more cash flows or appreciation, you're looking for steady cash flows. Now, this is where it's a regular income stream, but you're still very, very keen on capital preservation. What is the expected returns? 6 to 10, 12%. Drawdown, and when we say drawdown, basically what is the losses you expect? you don't expect any losses to be made on your capital, or maybe at worst, maybe a 1% here and there. What is the asset class available? And this is the first time, and this is the time when commodity arbitrage steps in as a very, very solid asset class. And then, of course, there is short-term debt. Now, short-term debt is, of course, whether you put it in a liquid mutual fund, whether you put it in a fixed deposit. These are all short-term debt instruments. Again, they give you regular income stream, they give you capital preservation. But that's the next goal. As you're now moving down this slide, as well as I would say up the curve in terms of your expectation on returns, but also a little bit on the risk, you look at absolute returns. Now, what is really an absolute return? An absolute return is a strategy which is agnostic to really the movement of that particular asset class, but will still, based on its strategy, generate returns for you. So it's a high predictable return. It can give slightly higher losses than the previous asset class. Long-term debt and equity with cash and derivatives as a mix is typically what people use for generating absolute returns. The next class, and we call it the compounders, because I think most of us that we know do invest in this asset class, and that's equity. You're looking for long-term wealth creation. There could be intermediate significant drawdowns, but you're expecting high returns. 15, 20, 40% is what you would expect. Sometimes you could even lose 20% or more. And typically, I think this asset class today is equity. Moving a little bit ahead, and you come to supernormal returns. So you're now talking of really something which will make it or break it. And this is basically what people are doing today in terms of equity investing in startups through either VCs or through Ps and those sort of funds. And the last but not the least is something where it's a lifestyle investment. People invest in yachts, people invest in art, people invest in diamonds. All of this is lifestyle. Huge returns, you could lose all your money, but then if it's a lifestyle investment, you really don't care. As I thought of going through this was to really establish where does commodity come in today as an investment class. And I'm going to take a little bit more time as we talk about distinguishing between trading and investment. But as an investment, commodity mainly plays a role when you're looking at steady cash flows, because especially if you're looking at compounders or others, today at least, I don't think commodities will play a big role. Looking at the financial markets, and maybe I'll stress again why it is important for all of us to understand commodities. A simple pie chart but tells you what people traded in the last year. And this is in terms of the futures and options. One of the reasons we are talking about derivatives today is that commodities in India, when we talk of commodities as an investment, it is possible mainly through derivatives, and which is why I'm giving you some picture on derivatives. Last year, globally, 50% trading in derivatives was in equities. But thereafter, if you see, commodities was the second highest. So if what is happening in the globe is an indication, it is an indication that you should be looking at commodities as the next asset class in terms of an alternative. Looking at the potential, and I think this is something which in my tenure previously when I was at MCX and even today have a huge belief, is that every economy has what is normally tracked as a multiplier, which is what is the ratio of the total derivatives trading in your economy versus the GDP of your country. It gives you some idea. It is not always the best indicator. It gives you a very good idea of where you think that market can go. Of course, the size of that dot or the ball is equal to the really size of the market. And there, as you can see, the United States is very big. The UK is at a ratio of 15.42, but that is a bit skewed because London traditionally has become a great global hub for a lot of derivatives trading, especially in metals and precious metals. But compared to the economy, therefore, it gives you a very big multiplier, and that may be misleading. But even a country like China and even a country like Malaysia is today at a ratio of about 1.7, 1.8. India, on the other hand, is a 0.35. So that gives you probably an idea of the potential that commodity derivatives has in this country today as a next emerging class. Another data point there is a thing which we track in terms of what is the multiplier between the normal trade, which is, when I say normal trade, means actual physical buying of gold and silver, versus the derivatives market. And if you see those ratios globally, if people buy 100 rupee worth of gold, they would do 114 times that 100 in terms of derivatives. In India, it is just 2.96. So again, it gives you an idea that the multipliers are very low in India, and therefore the likelihood that derivatives will grow in India is very high, in my opinion. So therefore, knowing that most of us, and I know the audience today at our PV Bhagwat investment cell has a lot of exposure to equities, I normally try and spend a little bit time trying to explain some fundamental differences between commodities and equities. I think the first fundamental difference is not that what I've said there, that this is a raw material and that's the shares or bonds. That is very obvious. I think the first fundamental difference is that each one of us who's bought a share and has seen that share price rise is very happy. Even if we have sold that share, we are not unhappy if the price goes up, because normally if we have sold a share and we've taken the money, we've invested it somewhere else. So generally speaking, the equity markets do not have a sentiment which is linked in one direction to the rise in price. On the other hand, just understand that a commodity every time impacts one person the other way. If the jeweler sells the gold at a higher price, you are unhappy. But if you get it at a cheap price, the jeweler probably lost some money. If the farmer sells his cotton at a higher price, he's happy, but that probably makes the ginner unhappy. So every time there is a price which goes up or down, fundamentally this market makes somebody unhappy. And that is the real reason why this market will be a little bit more complicated when you come to regulations, because you have to take care of both sides much more carefully than you would do in a normal asset class. Of course, where is it traded? Today in India, fortunately, at least derivatives are traded in absolutely a similar manner like equities and bonds on an exchange. Again, one difference is that the spot market, so the actual physical chana, the physical guargam, is not traded on the exchange. It is the derivative which is traded on the exchange. And in fact, the physical market is not under the purview of SEBI. The instrument life, that plays a very big role in this asset class, is that it's perpetuity in equities. You know, you issue a stock and it's there unless the company delists, which is very, very rare. In the case of commodities, especially in the case of agricultural commodities, and even for some metals, there is a shelf life. It's only the precious metals like gold and silver which do not have a shelf life. But otherwise, the instrument life is, again, slightly different. Coming next is, of course, that there's a big difference that there's a very constant face value versus in commodities, you can have several lots. And not the last or the least, but the fact that the supply is generally fixed in the stock market. You know, once there's been an issuance, there's that much shares of Infosys available. The supply just varies every year, either based on the mining in the case of metals, or in terms of agriculture, then in terms of the facility, in terms of the crop that comes through. So fundamentally, a huge difference between these two markets. Understand them before you start looking at this class as an alternative for you. Why again is it important? And I've shown a graph of, one very simple one. We all love gold, and therefore I've shown Nifty versus gold. Huge variance there, right? So if you're really looking for diversification, there is no doubt, and there are many more commodities you can plot like this. I've just shown one, but you can therefore see that it makes much more sense for you, if you want a diversified portfolio, to look at commodities as a diversification. Coming really to gold, and I'm going to spend a couple of slides on gold. One, because in India, bullion in general and gold in particular is everybody's dear. I mean, we just buy and I won't say consume, because I think it is all stored somewhere, but we do buy and just consume in that way a lot of gold. But when it comes to gold, really we must understand every participant, and we must understand what you and I as an investor, as a retail person, can do in this market, and where is it that we should really be looking at when it comes to gold as an investment. The overall value chain, and I'm talking of, say, a bullion wholesaler, a jewelry manufacturer, a retail jeweler, all of them, of course, if they want to speculate, they can always speculate on this market. But If they want to hedge their exposures, it is very, very easy and possible for them. And I will take, I think, the next slide, which is probably better in terms of explaining. So all of us, I think, have been to a Titan showroom. I think that's not something which we have not done in our life. You go there, you like the jewelry, you buy it. But really what has happened is that Titan has probably bought the gold a month ago. Titan maybe bought the gold at, say, 45,000 rupees per 10 grams, made the jewelry, put it up in its showroom. Somebody like you went there, liked it, bought it. At that time, the spot price of gold is actually very different. And if the spot price of gold has moved up or down, does a Titan make that much loss? If Titan's fundamental business is manufacturing of gold ornaments, then they would never do that and they would hedge themselves. How would they do it? Well, because buying of the gold when they are making the jewelry is a spot buy, they would hedge themselves by selling the futures. And because these asset class is very well correlated in terms of how the futures move, I've given a short illustration, but essentially, irrespective of whether the spot price of gold goes up or down, Titan as a jeweler will not lose any money in this whole transaction if the price of gold goes up or down. So please understand that these markets are very good for the physical market in terms of hedging. Now let us talk of investing, which is what you and I are looking at. Can you and I invest in gold through the commodity markets in the derivatives? Of course you can. How would you do it? You would basically go and buy the derivative contract. Now, there are two choices you would have. Either you take physical delivery of gold, in which case you are really not participating in the derivatives because you've come out of the derivatives. You've got a physical gold bar somewhere in the vault, and you are just buying gold and keeping it for perpetuity or whatever period you want to. On the other hand, if you want to have exposure to gold and therefore you're looking to track it as a price, you will have to keep rolling over your positions, and there's a cost of that rollover, and that cost could be something like maybe 6% per annum. So it's not a very cheap cost in terms of rollover. But yes, because you get leverage, for buying 100 rupee worth of gold from a derivative contract, you probably have to put up only 10 rupees in terms of capital. So it's a very effective way, but it's still sometimes not the best way when it comes to an investment or a retail investment. The next two, sovereign gold bond, and that's something which is a new instrument. It's something which I personally like a lot. And I say that because most investors look at gold as a long-term investment. It is a balancing, as I said, it is an asset allocation. And in that sense, the sovereign gold bond today is something where you hardly pay any expenses. You get paid a small interest. It's, I think, 2.75% that you get paid. Of course, that interest is taxable. As an instrument, it's a long-term capital gains because it's a security that you're buying, but you get it in the form of a demat into your account. The only downside of the sovereign gold bond, if I may say, is that it's got a 5-year lock-in. But if you're looking at gold as a long-term investment, as a hedge, I think it's a great product. The second one, which I would again strongly recommend in terms of retail investors, is the gold ETF. There are a lot of ETFs which are available today in the country. They track the price of gold very, very effectively. I personally believe that if they start using commodity derivatives as a part of their portfolio, they will actually not also have that expense ratio of 1% because they can easily compensate that by using the gold derivatives very effectively, and that may happen. They're tradable on the exchange, so they are highly liquid. You don't have to worry about liquidity. So therefore, in that sense, gold bond versus gold ETF, both are securities. ETFs are very liquid. I don't think that 1% is really a big drag and it will go away soon. Yes, you don't earn anything. You don't earn that 2.75% which gold bond gives. So it's a choice. If you don't want the lock-in, go for gold ETFs. But if you're okay with the lock-in, you might as well go for sovereign gold bonds. Next, and I think as you would slowly realize, I think I would never go towards the right side of this slide. Physical gold, yes, all of us like it. It's there because we like to see it. Sometimes it gives us that comfort. It's something which we have done in the past. But again, I think as the economy is really, really moving away from cash-based, coming out of people wanting to not disclose their incomes, I think gold as a physical holding will lose its sheen. And the last but not the least, and I wanted to spend time here because I'm not too sure whether in today's audience we have people like that, but there is a very popular retail scheme of the jewelry deposit scheme. You make a sort of 12-month deposit, equal deposit. 13th month is paid by the jeweler. You think you're getting a great 8.5% interest. In reality, what is happening is that you're paying the jeweler for 12 months, and that money is lying free with him. If you look at cost of capital, and even if your cost of capital is lower than the jeweler's cost of capital, effectively that 13 month is nothing but your own money being paid for you at the end of the 13th month. But just look at what is happening after that. One, you're logged in to buying gold only. Second, you're logged into buying gold in the form of jewelry, on which there are fairly high making charges. And therefore, when you're exiting, you are likely to also lose something in terms of that investment. So clearly, if your objective is to make jewelry, by any means, go make jewelry, do it in any form that you want. But if your objective is investment, if your objective is to save money and use the asset as an investment or as an alternative, you can even choose gold ETFs, but I would seriously not do the jewelry deposit schemes. Having said that, let me just spend the next few minutes explaining what is the difference between trading and investing. There are a lot of people and my friends who are in the stock markets would always say it's actually a personal choice. Anybody holding a position more than 1 second, you can then define whether he's a trader or an investor. Because for somebody, 5 minutes is long enough. For somebody, 1 day is long enough. For intraday traders, they don't hold anything beyond a day. For some traders, they will not hold anything beyond the weekly expiry of that contract. But at the end of the day, it is alignment to your goal. If your goals are more short-term in nature, and if you're looking to faster build-up of capital, which has the risk of faster loss as well, then it's trading that you're looking at. On the other hand, if you're looking at slower accumulation, but your goal is really to hold it for longer, you're looking at investment. Again, like I said, time horizon obviously is short-term in trading versus investing is generally long-term. Trading fundamentally looks at technical analysis, whereas investing looks at fundamental analysis. And more importantly, a trader would normally be very happy with volatility. Many traders, in fact, are very happy with volatility because for most of them, whether the market goes up or down, they normally make profits. Whereas for an investor, you're normally indifferent to volatility because you're holding it for long enough. So when it comes to commodities, I make a very simple distinction. Till about a year and a half back, commodities was not available as an investment class because it was only available as a class for trading because you could trade in the futures and options on exchanges. In the last 1.5 years, pooled vehicles for retail investors in the form of AIFs, mutual funds have become available. And therefore, commodities as an investment class has now emerged in India. And there, I personally always, whenever I'm talking to people, especially individuals and retail, make it a very, very strong point to say, be careful if you're trading. And I think, that sign which I have here of that petrol pump should tell you why I'm saying that. For all those of you who saw what happened on the markets in terms of the crude price, the crude contract globally had never seen something like this. It started going down. The COVID completely destroyed the demand. Supply was still growing, and the big difference between the WTI, which is what trades in America, versus Brent, which is what is traded in the North Sea and most of Europe and the other places, there was a huge shortage in terms of the people's availability to store that. And because crude is a deliverable contract, essentially as the contract was approaching its last day, there was a complete shortage of storage space. And what this led to was the inability of traders to take delivery. So they either had to square off the positions, and they were willing to do that at any price. What did that do? It took the price negative. Now just imagine what happened in India. One, we have a contract which mirrors the WTI, not the Brent, in terms of the active contract. Obviously, because in India it's a cash settled contract, it was maybe some people expected for it not to go negative. Some people thought it would go negative. More importantly, the Indian ecosystem had never ever tested trading negative rates. And when you look at risk management systems, you put in 5 rupees, any risk management system today in India would assume that the maximum loss is 5 rupees because the value can go to 0. But if you allow the value to go negative, the risk management system fails because now the loss is infinite because since the rate can go negative, as much as the rate goes negative, it's an infinite loss. And in the end, and I don't have data, but I think if there were any retailers who were trying to think that they will make money, I think a lot of them lost money. So again, I always tell people, beware of whether you're getting in as a trader or as an investment. So what are the opportunities? And because we're talking really of COVID and what it does in terms of this, I gave this whole background to tell you, commodities has emerged already pre-COVID. And this is where it stands in terms of the today's scenario. Bullion, arbitrage is possible, physical investment is possible, and it is available to trade as a security very easily, ETFs and bonds. Agricultural commodities, of course, arbitrage is possible. You can do physical investment in agricultural commodities. Securities, like I said, is emerging. Why do I say that? Because ENWRs are not yet traded. So these are the negotiable warehouse receipts. Or also in terms of AIFs, mutual funds, they're just emerging. So, securities as in units that you might hold, and for them to really become tradable and investable will probably take some time. The same for base metals. But when it comes to energy, there is no avenue today, at least, unless some mutual fund decides to use that as part of its portfolio. So in India, 2-3 things which you should remember. We are, I think, one of the safest markets when it comes to investor protection. And now that commodities has been under SEBI for more than 4-5 years now, almost, I think the market is safe. So should you look at this market and is it safe enough? Absolutely it is. Second, SEBI has now allowed a whole host of pooled investment vehicles. So you can do commodities through AIF category 3 funds, through mutual funds. And while there are slightly higher restrictions on mutual funds, I think pooled investments are really a very good opportunity. Then coming to what did COVID do to this market? And I've tried to bunch this into 4 sort of buckets in terms of where COVID has impacted commodity markets. The measures that we have seen in COVID in terms of what the government is trying to do to help the MSME market tells us 2 things. One, of course, we all know that the MSME market has been one of the worst hit. Secondly, if you look at the commodity markets, the MSMEs have a huge reliance on the base metals. Are the MSMEs participating in this market adequately? I don't think so. Do the volumes on an exchange like MCX show that the volumes have actually gone down in the last 1 year? That is the reality. Why does this still present an opportunity? Because as people and the government and every organization is trying to revive the MSME sector, as MSMEs themselves realize that they have probably missed an opportunity to hedge some of their risks, I still see the silver lining in this, that as MSMEs come back to life in terms of their businesses, as they realize the importance of using hedging as a tool, the depth in the commodity markets will go up manifold. And that to me is really the positive impact that I'm seeing coming out of this. Of course, till such time as some of the measures taken by the government really ignites this sector, this may not become a benefit for the commodity markets. Secondly, and this is one place where I do see a very, very clear impact. The government has really put a lot of money aside for a couple of aspects in the infrastructure side. One is through additional emergency working capital fund for farmers. The second is through an agricultural infrastructure fund. And this one is the one which I think is going to have the biggest positive impact for commodity markets. And why do I say that? Because it's clearly defined for farm gate infrastructure. And if you take this a bit one step further, in the Indian market, one of the reasons why what gets produced at the farmers end is actually sold finally to you and me at a much higher price is that there are just too many layers in between, because there isn't adequate infrastructure available at every stage for people to store the commodities. Warehousing is still not as developed as it should be, and warehousing is still not at the doorstep of the farmer. So if we are able to exploit this window that is being provided by the government, and I do expect a lot of people who have thriving warehouses businesses to come in and make use of this opportunity, warehousing will go up. If warehousing improves, it clearly makes it very, very attractive for the commodity markets in general. The next, and I think there I see two very, very important reforms that could revolutionize the commodity markets. The first one is the amendment to the Essential Commodities Act. Uh, uh, the whole aspect that, because a lot of the commodities were treated as essential commodities, and therefore there were limits on what you could hold, there were limits on what you could store, meant that private enterprise was always very wary of entering commodity markets. I don't think any one of us can deny the fact that if there is nice and big capital which is invested in any part of the entire value chain in a commodity, it will benefit the entire commodity. But if a corporate is very wary about getting into a commodity because it will get covered under the Essential Commodities Act, you could then have very draconian action against you. You were really not willing to be in that field. So to me, this is a game-changing reform. It will bring in a lot of corporate participation in the commodities, especially in India's agricultural commodities, and it will be a big positive for the market. The second one, again, that to me is again a game changer in terms of the agricultural marketing reforms. For very long, I think many of us have said this. Many of us are feeling that APMCs and the restriction that a farmer had to go to his nearest APMC was always a restriction. Now that restriction will hopefully now completely go away. Somebody, and I read this and I thought that was the best comment I read. He said, not only will this make sure that the farmer can sell what he wants, where he wants, the farmer will now make what the market wants. So, the farmer's ability to actually give products which are beneficial to the market and which therefore are beneficial to the farmer himself will go up drastically. Why is this another opportunity? Because in India, for its size of the market, as a overall commodity market, the derivatives that we really trade are very few. And that is because there isn't enough liquidity, there is no uniformity of the market. But as and when we are able to make the one market out of India, I think the depth and the liquidity in this market will go up drastically. So to me, this is the one set of reforms which will really bring the commodity business to a big jump going forward. Last, and this is something which is a development which I think we should watch. India has a very vibrant energy spot market. I don't know how many of you know it, but electricity spot trading is very vibrant in India. People trade it, and that is one reason why probably over the last 8-10 years we have seen that a lot of the woes of electricity, especially in terms of people not having enough electricity when it comes to supply and generation. Finally, at the end consumer, there may still be problems, but today the ability for people to actually sell their surplus, on a next day basis, is become a reality because of the electricity spot exchange. Coal mining and other such infrastructure, as it brings up some of the other energy avenues in India, I think will hopefully lead to more spot markets coming up when it comes to energy. And once you have a thriving spot market, I think it will lead to a good derivatives market. So overall, what has happened in COVID will lead to the strengthening of that case, which I said earlier, that commodities will become a true alternative class. Is everything hunky-dory? Obviously, no. I mean, at the end of the day, there are challenges. The challenges are the fact that when you're doing arbitrage, and which is something which I said is the best opportunity when it comes to commodities, you have to be very clear that you need to be able to handle the physical commodity. Because when you say arbitrage, what are you doing? You're buying soya from the mandi where it is available, and you're either selling it at a future date on the exchange, or you're selling it to a crusher. But in any possible way, you have to have the ability to actually process that physical trade of buying soya, storing it for some time. You need the ability to manage your GST, multi-state GST, and all those things. So that is something which means you need a fairly good back office or at least support system in terms of these things. Pooled vehicles, like I said, it's a very good thing. Are there enough intermediaries? No. I mean, to the best of my knowledge, there are 4 or 5 AIFs. To the best of my knowledge, only one of them actually takes physical delivery of agricultural commodities and makes use of this avenue. There is only one mutual fund. And in these pooled vehicles, there are restrictions on investments. Now, my way of looking at it is that that's something which we should not really be bothered about, because if even these 2 or 3 AIFs and this one mutual fund or 2 mutual funds do grow their AUMs, do a good job, I think collectively we can all go back to SEBI and say that the reason they are not growing is because there are restrictions. I don't think SEBI will stop us and not remove those restrictions. I think the next one, and that's something which is still a challenge, is in terms of the size of the opportunity. The commodity derivatives market in India, as much as we would all love it, is still a bit shallow. It is still a bit not too wide. We don't have enough commodities. There are 91 commodities which the government of India, through its notification, allowed for trading, on which derivative contracts are available for 35. Not more than 10 are liquid of those. And if you really want to do arbitrage, you're probably then restricted further in the agricultural side and further in the base metal. So I think, that is one thing which is still a challenge. But like I said, if some of the measures taken during this period, especially in terms of opening up of the market because of the dismantling of APMCs, because of the taking away of the Essential Commodities Act, I would think that the size of this opportunity is really going to grow. I will add one caveat, and I think it's a discussion which all of us love to have, is that, will this make India the price setter globally? Honestly, I don't think it'll happen so soon. I mean, let's be very clear. When it especially comes to derivatives, which is what we are talking of when we are talking about financial instrument, it derives its value from the underlying, and therefore the underlying should be, the main market should be India. And for that to happen, we should have free capital movement. So as much as a lot of us believe that the price of gold should get determined in India because we are the largest consumer of gold, or whatever be the case, the reality is that India doesn't have a free flow of capital, and therefore trading wise, it is still London which determines the price of gold. Cotton, where we are not just the largest or the second largest producer, I think, and amongst the largest consumer, we also export a lot of it, but the price still gets determined, I think, on ice. And that's something which we should, therefore, we should also be cognizant that some of these things will take time. It's not going to happen overnight. But yes, over time, maybe we will reach there. Last but not the least, and this is where I think today's seminar is going to play a very big role, but I don't think there are enough people who understand commodity markets and commodity derivatives. Hopefully, efforts like this will make a lot more people understand what is the potential of this market. And if they understand the potential and believe that this is the real next emerging asset class, they will really come into this field. So yes, India has a lot of manpower available. I think in the early 90s, we used to say the same, that we don't have enough specialized fund managers. Today, India has now the most thriving fund management industry. I think the same will happen on the commodities. So in summary, before I really open up to questions, please understand the difference between an asset class for trading and an asset class for investment. Align that to your own goal. If you, of course, want to be a trader, you have the opportunity has been there for the last 15 years. Then we are not talking of commodities as an emerging opportunity, because commodities for trading has been available for the last 15 years. But if you're looking at commodities for an investment, yes, it is available now in the last 1 or 2 years. The good thing is that it is under SEBI. It makes it safe. But yes, fundamentally, it is still very different from equities. Commodities offers a very good opportunity, in my opinion, for a safe investment with steady income, commodity arbitrage, and we have a very good demonstrated track record at my firm where we have done this. It's a very, very good investment opportunity for anybody. Post-COVID, so if this was all the reasons why this was good pre-COVID, I think post-COVID, like I said, 2 or 3 big events may really trigger the next growth cycle, and I think that is why post-COVID, I would be even more bullish on commodity derivatives and commodity arbitrage and commodity as an investment class. And the last way to access commodities, I would still say, assuming you're an investor, is through pooled vehicles. If you are, of course, a trader, you can do it on your own. Because if you're an investor and you want to do it on your own as an individual, your ticket size needs to be so large that I don't know whether that's something which you want to look at. But of course, yes, if you've got a very large ticket size, you can invest and look at commodities as an investment, even as an individual investor. So AIFs, of course, are a better bet than even mutual funds today because they have lesser restrictions. But that, to me, sums up where I think the whole thing is. Just a last word, last 1 year, I've been with Alpha Alternatives. we are a multi-asset class firm. We do commodities in a very big way. And therefore, on that, while I'm not a fund manager and I don't really give advice on how to invest in which commodity to pick, I'm very happy to put you in touch with anybody who's interested with somebody at my firm. Back to you, Dere sir, for questions.
Yeah. Thank you, Mrugank, for an excellent analysis. Now I will ask Uday to ask plethora of questions which are with him already, and those which may come from the audience. Uday.
I think, Uday, you're on mute.
Am I audible now?
Yes.
Yeah.
Yes.
Thanks for the excellent presentation. And many of us had a little anxiety whether the presentation on commodity becomes gold centric or what, because the perception in the investor's mind when commodity comes is only gold and nothing else. But thanks for covering all the aspects. I have a few questions received from the audience as well as some of my colleagues who had given me earlier. First question I want to put you about the crude negative price which happened, because everybody is keen to know. You covered the risk element, the commodity versus equity, and generally we say that when we buy shares, our liability is limited, so we don't pay beyond whatever is due towards allotment or call money, etc. Now in this new scenario, the major risk factor has opened up in the commodity segment. So how do you perceive risk in this? Because during COVID, we understood something beyond our comprehension. So in that respect, equity versus commodity, how do you compare?
So I think you've already put it very simply that the risk comes in because, like I said, normally you would assume that if I put in 5 rupees, that's all that I can lose. But here, if I put in 5 rupees, I could still lose as much more, and there is no limit. And I think that is the first reality that all of us should understand. Yes, it's a one-off event. Yes, it's something which has happened probably it has happened, I think, for the first time. Will it happen again? In fact, it didn't happen at the next expiry of the WTI contract. Notwithstanding that, it's a reality. So first and foremost, please factor that in when you're doing it. Second, if you're looking at therefore investments, understand very clearly which commodity is likely to. So I think if you try to put it fundamentally, Uday, what happened really was that the cost of getting a storage, if you were allotted delivery, just went way above the actual price of crude, which in itself was actually going down. So that was the theoretical way of understanding it. Now, will that happen for many commodities? May not happen. But haven't we seen that happen in India? I mean, the farmer who throws away his tomatoes or onions on the road is nothing but that same thing happening, because the farmer cannot store that commodity anymore and cannot get a price for his produce, which is remunerative enough after factoring in storage costs, which is why he just throws away the produce. So I think we have seen this happen many times. This time it hit investors and retail investors because they were trading on the exchanges. But to me, understanding this risk is the most important thing. Can it happen? It can happen. What should you do? Be aware of it. And again, take as good advice as you can, and also be very clear how you're investing in that asset class.
Yeah. Thanks, Mrugank. Since you picked up the food grain, I'm jumping to the same question. We spoke about the reforms in terms of Recent Commodities Act and the APMC being on the way of extinction. So when we are expecting the corporate participation in terms of maybe the interstate movement of commodities will be easier. So as at this juncture, the way we look at many of our produce, say wheat or rice, we have literally abundance in India today, thanks to good rains for last couple of years. So there again, that risk factor, when it gets corporatized. In fact, we may look for the cooperative farming here after maybe 2 years down the line. In that context, again, there is a risk of negative price in any of the food grain stock or agriculture stock.
I would again
just interrupt here, because
yeah.
what we have seen earlier is, like you said, people throwing tomatoes or chilies and so on, because it was a perishable kind of thing. Whereas it gets corporatized, you spend money on your warehousing, and still there is an issue for storage. Like, say, God forbid, flooding happens. So what is the risk involved there?
So I think one, in terms of what you mentioned on the reforms, I will just give a different analogy to tell you why I still think it's a great game changer. And this is in the days when the GST was not there. Gold, if you bought gold and imported gold and got that landed in Surat or Ahmedabad or in Mumbai, you typically would basically keep that in your vault in that city, and you would not take it to another city. The day after GST happened, one of the most interesting things which happened in the commodity markets was that buyers, the bullion buyers, were very happy to do interstate movements. I mean, I was at MCX at that time, and we saw people actually taking deliveries in Ahmedabad and shipping them over to Ranchi, shipping them over to Hyderabad and various other places. I think that in itself was a great game changer. So will this become a game changer? I definitely think it will, because interstate movement will facilitate a very lucid movement of goods. Second, to your other point, the fact that people can invest with some incentives, with some backing of the government in building infrastructure, I think that is going to be the next reason why the cost of building infrastructure and infrastructure available at the farm gate or available at the consumption point will become a reality now. And as infrastructure for storage becomes easier and better, the possibility that somebody will actually throw away their goods because they can't be stored is likely not to happen. Of course, perishable goods run that risk always. But I think when we are talking in terms of grains, in terms of oilseeds, in terms of all the other things that we normally look at, this possibility does go down. So I don't think, but again, I think nobody could have ever predicted what happened in crude, so I can't predict that it will not happen. But I don't think negative prices in especially the non-perishable items are possible.
Thanks. One slightly question, not just related to commodity market. In this context, the government's target is to double the income of the farmers by 2022. And what we have seen is, like you said, unlike the equity markets where the shares price moves up, I don't get affected if I've sold the shares because I got my price, whether profit and loss, whatever. But unlike in the commodities, when somebody sells at a lower price, especially below cost, it's a big issue. Now, do you realistically feel that this doubling of income, these major reforms in terms of scrapping of APMC whenever it happens, very welcome move, and also the draconian Essential Commodities Act, like we removed license Raj, but it was not known why it lasted for more than 3 decades. But in that context, do you think that the chain between the farmer and the ultimate consumer will get established in a probably a better manner so that it will win for both rather than the traders getting benefit of it?
So I will take one example, and I think it's an example which we have seen live. I have seen in my previous job, and this is a very small commodity, but I think the example is very relevant. This is mentha oil. Mentha oil is what is used for creating the mint that all of us use as a fragrance. The reality is that before mentha oil became a tradable contract on the exchanges, its price was fairly low. And second, the farmer was not really getting his full value for it. Over the 10, 12 years that this asset has been traded, one thing has emerged. And if you go to that belt in UP where this is produced, people actually call mentha oil liquid gold. Why do they call it liquid gold? Because the farmer today stores drums of mentha oil in his home. He looks at the price at MCX, and if he thinks that price is good enough, he just takes one drum and goes and sells it in the market. So what a liquid and efficient market has done is that it has enabled the farmer to decide what is the point at which he thinks it is good enough for him to store or hold his goods. And I think that is the fundamental difference that a liquid market will get. As APMC Act is abolished, as the farmer gets access to a larger market, I think that will first of all create more avenues for the farmer to sell. The second and more important is that as a spot market becomes very vibrant, I would expect the exchanges to develop a derivative on top of it. So I think that combination of having a large spot market with a vibrant derivatives market will lead to a definite benefit for the producer, which in this case will be the farmer. I think we have seen limited successes, but if this is done with a very, very simple objective in mind and a clean way of doing it, I still think it has great potential for benefiting the farmer.
On a lighter note, we won't look at a situation where Kolkata refuses to provide potatoes to Odisha, and Odisha in turn threatens not to export fisheries. So that could get over.
Absolutely, and I guess there will be enough people who will be storing those goods in the middle, and they will be able to supply them to both these states.
Yeah, and in that context, your previous organization, MCX, being a leading commodity exchange with close to 95% market share, what role you see for MCX in this coming scenario, and will it really benefit the investors?
So I think it will be unfair for me to make a comment on MCX, and it is a listed entity, so I would definitely not make any comments on that.
Maybe generally,
but
the role of
I would absolutely. So this is where I would say that, and let's not forget there are 4 exchanges in this country. There is NCDEX, there is MCX, and of course BSE, NSE are also been allowed to trade in commodity derivatives. And I think this is the opportunity. There are, like I said, 91 commodities which the government of India allows us to trade on derivatives. There are hardly 30 contracts which have been launched. So first, there is potential to do 60 more commodities. And even if we go by the past rate of success, where maybe out of 3 have succeeded, I think you're talking of at least another 20 very vibrant commodity trading opportunities coming up. And therefore, all the exchanges, I think, have a great opportunity in front of them. For an exchange like NCDEX, which has a very, very established name on the agricultural side, the opening up of the APMCs, this whole essential commodities going away, if it leads to a much larger and vibrant agricultural market, will lead for a very, very good advantage and a good opportunity for NCDEX to expand. So I think in general, every exchange in this country has an opportunity today. It is for each one of them to see which one they can capitalize on.
Coming to now the commodity close to everybody's heart, and rather entire body, I would say, the gold. A lot of questions on gold. First and foremost, I just want to switch from gold to silver. There have been not much attempts to create a silver ETF. Now, what's the reason? Because silver is also used on a very large scale in commercial use also, unlike the gold. But still, why there is such a disinterest or apathy when we talk about silver?
So let me give a little bit of history to that, and some of it is the fact that when gold ETF was launched, it was actually no man's territory, and the gold ETF got launched. That was the time when there was not enough clarity on whether an ETF would, especially an ETF on commodity, would come under SEBI or it would come under the erstwhile FMC. That little bit of separation of regulators was the primary reason why the second ETF never saw light. I mean, for those of us who were in the market, I used to be a custodian in those days, and we were actually preparing for a silver ETF, which never happened that time. Thereafter, fast forward 10, 12 years, and FMC and SEBI got combined. Fast forward another 3 years, and you'll have to fast forward because SEBI, in its regulations, has made it mandatory that an ETF can be launched only by an asset management company. So, unlike again a global scenario where an ETF can be launched, by a broker, for example. So a lot of the large trading firms globally have their own ETFs, but in India, only asset management companies can launch ETFs, and therefore it meant that unless you got AMCs to come into commodities, you could not. So I think silver in that sense really got enabled only about a year and a half back. To that, we had a little bit of other hiccups because there weren't too many custodians available to custody silver. And I understand that 2 or 3 custodians have now got the license. So my view, I guess there are now adequate number of players from the mutual fund industry and from the custodial side who can and will launch a silver ETF. I guess whoever sees the demand first will do that.
Yeah, the reason why I asked this question to you, let me tell you. In my role as a broker, then we actually were advocating ETFs in 2009 when the rate was around 9,000 rupees 10 grams for gold. And similarly, the interest rate that the silver rate at that time was hovering around 17,000. So if gold has moved from 9,000 to 46,000 today and silver from 18,000 to 49,000, so there are decent gains for the investors. So that is a loss of opportunity, I thought, in silver ETF for the investors. So that was my point in that context. Now, turning to the other questions on gold. You said that you personally like between the two schemes, that gold bond and ETF. You said that gold bond was your favorite. Can you just elaborate of these?
Okay, so let me go back to that. Like I said, first of all, let's be very clear. Am I a trader and am I an investor? And anybody who has known me for the last 30 years knows that I just don't know how to trade. So as far as I am concerned, I only talk of gold as an investment class, first of all. When we are talking of investment, then you look at saying, first, do I get the benefit of that asset class? What is the price I pay for it? How liquid is it, and how are the returns comparing with everything else? My reason for saying that sovereign gold bond is good is that if you're looking at gold as an asset allocation, you want to say put 5%, 10%, whatever you want to put of your total investments in gold, I'm assuming you're not so concerned about the liquidity. I'm assuming that. Of course, if liquidity is very important for you, go for a gold ETF. Okay, so my whole point is, go for something which is not costing you too much money in terms of the investment itself. It is very easy to buy a sovereign gold bond. It gets sold every month, I think from the 11th to the 15th. It gets allotted in demat form. It's in your demat account after 4 days. So it's absolutely the way you invest otherwise. The same holds for ETF. You just buy it on the exchange. It comes as a ETF, as a demat credit. So ETF versus sovereign gold bond, very little to choose. Sovereign gold bond gives you 2.75% interest, which the ETF doesn't give you. But sovereign gold bond has a 5-year lock-in. Make your choice between the two. I personally, because I look at it more as an asset allocation, and therefore lock-in does not bother me.
So liquidity and the in that context is a priority as you look at it. And of course, there is no storage. That's the thing. You're looking of something on the other side now, in terms of the options being available. One question is there whether it will be allowed on onions.
So let's step back. I think first and foremost, what is available for trading in India. So there are only 91 commodities available for trading. Onions is not in that. So first and foremost, it sort of is like you're stopped at the first place. Somewhere the government of India needs to get convinced that it is okay to trade onions in a derivatives market. And then that is the first step of change for onions to get traded. Second, the current state of commodity derivatives is that most commodity derivatives today, as in options, are available on futures. So it's an option on the future. It's not an option on the spot market. So when you talk of the gold options that are available, they are an option on the MCX gold futures. SEBI has now allowed you to have a direct option on the underlying commodity, but we haven't seen a product there. Okay. So to me, this is a very long journey. I don't think I will be trading commodities when we start trading options in onions.
So there could be tears in the farmer's eyes or our eyes as a consumer.
And again, if you're a trader, I think you would be happy. But if you're an investor, I would still be cautious about getting into options trading on onions, even if they are introduced. Go through it through your investment vehicle, which could be a pooled investment vehicle by then.
Yeah. In fact, on the option, there is a similar question that scope for options on goods or agri products. Say even milk powder needs to be traded now. What we learned from the COVID, like excess milk supply, so that could be done. So in that context, any possibility?
So again, milk powder is available in those 91. If the experience at COVID has convinced a few players that it is worth trading, I think it's an opportunity for one of the 4 or 5 exchanges. I mean, I assume they would be also looking at this data and they would jump at it and create a contract on milk powder.
In this COVID-like situation, again we have seen as a part of stimulus package, government did release the wheat, rice, and pulses from their stock, and the FN statement also indicated a couple of weeks back that government bought close to 74,000 crores worth of the food grains during this COVID period. So in a way, creating a liquid in the hands of the farmers in what they did. Post scrapping of APMC and the Essential Commodities Act, what role you look at from the Food Corporation of India? And in fact, if you can explain to our listeners also what role it plays as of now as a government body.
So I think FCI steps in terms of the entire cycle, both when it comes in as procuring both under the MSP or when the government undertakes large procurement. The second role which FCI plays is in terms of really creating huge reserves of any of the commodities, which helps in stabilizing the prices. So I think FCI's role, I don't see getting diminished, because in every sense, the government will remain one of the largest consumers or at least buyers of many of the commodities. What will change, I think, Uday, is the fact that you will now have adequate large capitalized players coming in and getting in and stepping into the value chain, which will then make the market more vibrant. Today, large scale purchases are only FCI. So even in cotton, for example, it's only, everybody only looks at what CCI is doing, because Cotton Corporation sort of almost decides whether people are going to buy more cotton or not. So I think it is the role of the government will also get slightly reduced in terms of the role it plays. And you will see larger private sector players coming in going forward.
But the FM also indicated that there could be public-private partnership in this context to take care of the whole of the logistics. So does it mean that even FCI will have some sort of a connection with these private players, or how it is likely to come up? Any idea on that?
No, I don't think we haven't seen anything on that. I mean, if FCI privatization or FCI partnership with private sector is a part of the plans, I guess we'll have to wait to see whether that gets announced.
Because there was also indication that will not privatize, will corporatize certain government organizations. So was there some tacit indication that even FCI could step in, because all of us know the way FCI has been handling things, and if you really look at making it professional body, these private partners could come up. And coming to the same issue now, we have large retail chains in India now, like the D-Marts or the Ambanis. What role they are likely to play? You look at this, because we have seen this COVID situation. Large, if you have seen in Andheri, large queues for D-Mart, and this is close to our heart that they are offering the fair amount of discounts. Unlike, I don't make any allegations, but unlike the private kiranas, they are fleecing today, if you look at the prices. So in that context, will these big players likely to get into cooperative farming, or in whatever way they'll, because that will make our life easier?
So, again, difficult to speculate whether some of the names that you took will get into cooperative farming or not. Do I see them getting more integrated into the value chain? Definitely. I mean, if I see a D-Mart and its model, if they would be able to control the supply chain better, why wouldn't they do it? And I think we have seen that happen in some of the larger chains as well. To a lot of people who know the growth of what happened in the whole Pantaloon and the other parts of the Biani group, they actually started an in-house logistics company, which thereafter became a listed entity. So I think backward integration into logistics, which covers both, just not the warehousing, but also the movement of goods, is not something which will not happen. I would assume that a lot of these companies would get into the logistics aspect as well. Again, makes the sector more profitable. I think just more participative, and you'll get more investments into the sector, which is more welcome.
In case, like we say that we cannot predict that fine, but do MSMEs then get linked to these two giants or four giants, whatever we are talking about?
Pardon, can you just repeat?
MSMEs could venture into this post-COVID era.
So, are you saying can an MSME start a warehouse? Of course,
Correct,
they can.
Correct.
And again, to me, who would be the person who would take that opportunity to start warehousing as an activity if there is support available from the government for funding? It would be somebody who is either a larger player or an MSME. In every place, again, if you are talking of building warehouses all through the length and width of this country, especially at the farm gate, as we are talking of, every place you're not going to get the large corporates. So it is the MSME. So to me, for somebody who is an entrepreneur, wants to get into warehousing or wants to get into the entire logistics business, yes, it's an opportunity. Will MSMEs get into it? I would assume so.
Because we have such a strong cooperative movement in Maharashtra. And we have seen Amul as a great example to emulate. So something of those sorts where some smaller towns or bigger villages, whatever you quantify as that. And there are a lot of people who are getting into business as well in these areas. So is the government will be really serious to support them so that they can store largely at the local place than just moving helter-skelter?
So again, I don't think any one of us would have so much of idea today about what the government plan is in terms of encouraging either the logistics sector or encouraging the cooperative sector. Like I said, clearly the intent of the government is to have more investments being made in terms of logistics. I think that is the only thing which we know as of today in terms of details.
One question related to equity now, but on commodities. We have PMS with a threshold of 25 lakhs, and SEBI looks at again increasing from 10 to 25, 25 to 50 now. So commodities per se, the PMS hasn't come up yet. So you see the light at the end of the tunnel, and when exactly it's likely to come, because SEBI has just made a reference to that, but nothing has done any concrete steps on PMS on commodities.
So from a regulatory perspective, I think it's not so much of whether it is allowed or not allowed. You have to look at the construct. PMS is not a collective investment in the sense that you don't collectively hold the underlying, right? In a mutual fund, the shares are held by the fund. In an AIF scheme, also the shares are held by the AIF. Similarly, in commodities, when you're doing an arbitrage, for example, you will hold the position in the scheme, and the goods that you get against that position, assuming you take delivery, will be again held by the scheme. So even if there are 50 investors or 1,000 investors, the entity holding that asset will be just one. In PMS, as you know, that it is mandatory that every asset has to be held by the individual investor. And like I mentioned earlier, the ability of individual investors to hold physical commodity as an asset is still very limited, because you really don't have the ability to do the related GST. You don't have the ability to do all the other work that goes with it. So I think that becomes the limiting factor for PMS to come in as a model in the commodity sector. Of course, if somebody comes up with a PMS scheme which only looks at cash settled contracts, or which looks at, that is a possibility. But then that's a very, very small piece that you're talking of. Today, there are only the energies contracts in the exchanges, which are cash settled, or the index contracts. But everything else is physically settled. And if it's physically settled, imagine you or me holding whatever,
Right.
one lot of cotton, which is 100 bales in Akola. I mean, I don't even know whether you and I will be able to do it, right? So holding of the underlying asset is the limiting factor for PMS not to become attractive for commodities yet.
But if this was again simplified by way of the warehouse receipt, electronic warehouse receipts, how we have DMAT, and is the regulator, you think, very serious that only PMS only for commodities? So is there something likelihood?
So again, Uday, I think the solution is not so easy because today also, as you know, the ENWR, which is the electronic negotiable warehouse receipt, is what is issued by the repositories. Repositories have been set up under the WDRA,
WDR.
which is very, very similar to how depositories have been set up in India. The framework is very similar. The instrument is very similar. But the ENWR, first of all, is not a security under SEBI Act. It is still only a warehouse receipt. And secondly, the fact that when you are going to move the ENWR, the underlying goods are going to change hands, you will have to then have a mechanism to manage the GST, right? So because there is an underlying physical goods below that warehouse receipt, you will have to have that wherewithal, and that till you are able to find a solution to it, you will not be able to make ENWRs so freely tradable like any other electronic receipt.
So like we have situation in debt retail market, so is commodities until it really develops, as you said, because we still find that we are just crossing the infancy probably as the commodities market we look at as compared to the gold one. I think Mr. Dere wanted to say something.
Yeah.
Dere sir?
So I'll only make one comment on that before Dere sir comes in, is that Uday, since you and I started our careers, I think we have always spoken in every seminar about how debt in India should become a retail product.
Yeah.
And we still talk about it. I think you and I will retire also.
Correct.
One bet which I'm willing to take is that the same will not happen for commodities. I think commodities will definitely become a much wider accepted asset class through the Indian investors than debt as a retail class.
That's great. I think Mr. Dere is yet to join. One simple question
Yeah,
I
yeah.
wanted to ask.
I have one question.
Before that one question, Dere sir. We have seen the relationship between gold and silver, both the precious metals very close to traditional Indians, and the ratio of the price of 10 grams of gold and a kilo of silver, we have seen absolutely sea change now in terms of the price. What I'm talking price in India. So now it's like neck to neck 1.05, that kind of thing. So historically, what has changed that this ratio is coming closer?
So again, I will admit I am not an expert in any ways on predicting or analyzing prices or price movement. However, when it comes to a ratio of two asset classes, well, commodities offers some very, very interesting examples for people to trade. I mean, globally, the most liquid contract in terms of trading is the Brent crude spread, right? So WTI versus Brent spread, it is the most liquid contract in the world. Fundamentally, it is one way of one type of crude versus the other type of crude. Similarly, the gold silver ratio is another popular trading contract. And like I said in the beginning, trading contracts is not my forte, but yes, it's an opportunity for people to trade. Anyways, I don't think it makes for an investment.
I think people like Srikanth were keen to know about it. Yeah, Mr. Dere, please continue.
See, for historical reasons, there is no income tax on agricultural income. And people say that agriculturists, they do not have income, they have only losses and things like that. And therefore, large portion of GDP is out of taxable net. And attempts have always been made to bring in agricultural income tax one way or the other, but for various reasons it is not done. Now this present move of linking the corporates to the agriculturalists directly, will it amount to some sort of synthesization and bringing all those people also indirectly under income tax net, etc. What's your view on this?
So, sir, I have a couple of observations. Again, tax is a very complex subject in any ways. But one, to your observation, agriculture as a part of our GDP, I don't think is such a large percentage anymore. From what I think one of my colleagues made a presentation yesterday, it's probably in the sub 20% today. So is it a huge percentage of the GDP? No. Second, unfortunately, a large percentage of the population is still in the agricultural sector. So I think in that sense, you've got 20% of the GDP, but maybe 60% of the population. And given that complexity, would any government suddenly want to make this taxable? I don't think it is something which any government will look at, because it is definitely not what will get them any amount of popularity. So I don't see that happening. So even if the sector is getting corporatized, I don't see this as a precursor to agricultural income being taxed.
Anyway, thank you very much, Mrugank, for an excellent session. We enjoyed a lot and we learnt a lot also.
My pleasure, sir. My pleasure.
All of us are ready and willing to join hands, but e-hands. So you can't see the clapping, but you will see our appreciation in any way.
Thank you so much, sir. Thank you.
Anyway, coming to our next programs, on 7th of June, there is going to be a lecture by Mr. Uday Tardalkar. On 28th of June, Mr. Manoj Sathe, a former NSDL, he is also going to make a speech. So, and on 14th of June, there will be another session on taxation, which I will be addressing to the members. So let's wait for the future announcement, and let's now stand for the prayer. आता विश्वात्मके देवे येणे वाग्यज्ञे तोषावे तोषो निमज द्यावे पसाय दान हे देशांची
वेंकटी
तया सत्कर्मीचे दुरितांचे तिमिर जावो विश्व स्वधर्म सूर्ये पावो जो जे वांछील तो ते लावो प्राणी जात वर्षत सकट मंगळी ईश्वर निष्ठांची मांदियाळी अनवरत मंडळी भेट तू भूता चला कल्पतरूचे आरव चेतना चिंतामणीचे गाव बोलते जे अर्णव पियुष्याचे चंद्रमे जे अलांछन मार्तंड जे तापहीन ते सर्वाही सदा सज्जन सोय रे हो तू किंबहुना सुखी पूर्ण तिनी लोकी बजिजो आदि पुरुखी अखंडित आणि ग्रंथोपजीविये विशेषी लोकीये दृष्टा दृष्ट होये होवा ओजी येत म्हणे श्री विश्वेश्वराओ हाओ येईल दान पसाओ येणे वरे ज्ञानदेव सुखिया झाला. So let's meet on 7th of June. So we close the meeting. Thank you very much.
Thank you, sir.
Thank you, everyone.